All right. Well, again, thank you everyone for sticking with us. Those of you that are still here, we will try to make sure that we get this wrapped up. I can get you out of here on time. I'm your presenter today. My name is Alex Perney. Again, sorry for the delays with the technical difficulties. I'm a certified IRA services professional here with Advanta IRA, and today we're going to be exploring how to use an IRA to do private lending. In other words, how to use your IRA to lend money out of it to get fixed returns, and how to better negotiate an actual product that is going to be favorable to both you and the borrower, and also help you determine the terms of what you're actually investing in. A brief disclaimer before we get started: Advanta does not provide any tax or legal advice. We encourage anyone before entering into any legal or financial arrangement to consult the advice of tax professionals or attorneys to make sure it is a viable and sound investment for them to be pursuing. Advanta and our employees, again, do not provide any tax or legal advice. A few key points that I want everyone here to take away from today is that any IRA or former employer plan can qualify to be rolled over or directly transferred into an IRA without paying taxes or penalties. You can choose the borrower and the collateral that inherently secures the note that you're going to be lending out on, and all of the interest and the profits from the particular note that you are investing in are going to all be channeled and flowing back directly into the IRA, tax exempt from any current taxes that would be applied to them. So again, any type of plan qualifies. You are choosing the borrower and collateral, and all of the income from this investment being flowed back into the IRA are the three key points that we want to make sure you take away from today. Here's a brief agenda of what we're going to get into today. And a little bit about us is that we are a self-directed IRA administrator. We do serve clients nationwide. We have a good base of information and products that you can use to explore what you are trying to accomplish. We have over 20 plus years of experience. We have a good network of CPAs and attorneys. If we do need to refer people out to get that advice, we can certainly give that information out. And currently, we need to update that. We manage a little bit under $800 million of capital under management for our clients. We do have two locations: one, our corporate headquarters here in sunny Largo, Florida, and an office in Atlanta, Georgia. So if you are local to either of those, we do encourage you to stop in, say hi. But we do operate nationally and internationally, so long as you have a good internet connection and a phone, we can pretty much get the investments that you want to get done in a self-directed IRA accomplished for you. By virtue of the fact that you are here today, you are taking part in one of our events, but we also have all of our webinars that we do hosted on our YouTube channel. So if you want to go to our on-demand center, if you want to review everything that was gone over today, or you'd like a little bit more clarification on a specific topic, head on over to Advanta IRA and check out what we host over there. Everything is hosted on YouTube, so it should be very compatible and easy for anyone that wants to take part in it. And we also keep an up-to-date blog that has a good amount of information with regards to current industry trends and things that are happening around you with regards to IRAs, real estate, lending, and other types of investments that lend themselves to being done in a self-directed IRA. So what is self-directed IRA? All IRAs in their DNA essentially are the same type of account. The main difference is what your IRA administrator will let you invest in. So people such as big banks and brokerage firms, they're going to specialize in financial products that they sell and make money to you, whereas we specialize in the record keeping and reporting aspect of things to allow you to choose the investment that most makes sense to you and allow you to get a hands-on approach to take control and invest in what you know, while still maintaining the tax-free and deferred gains that you enjoy from an IRA. Now, there are many different types of accounts that can be self-directed. It's not simply just the traditional IRA. Although the traditional IRA is inherently probably one of the most popular type of IRAs that is out there, it certainly is not the only one that can be self-directed. Up on your screen, you will see the different types of accounts that we administer, and there are several others as well, but these are the predominant ones that we see most of our clients opening. The traditional IRA is going to be a deferred taxation plan, meaning that you got a deduction for adding money in. Now, this is also the type of plan that will most often have a 401k or other type of employer's plan rolled into it, so it is certainly the most popular by virtue of the fact that most people have old employer's plans and without wanting to pay taxes have moved them into a traditional IRA in order to gain greater control after they've left that current employer. Now, a type of plan that gets a lot of press for good reason is the Roth IRA. Now, the Roth IRA is going to allow you to get fully tax-free gains because you have paid taxes going into the plan, whereas opposed to the traditional IRA, you pay taxes on the way out. All of the earnings that are going to be associated with the Roth IRA are going to be completely tax exempt. Now, each one of these plans up here can inherently be invested in notes and mortgages, and the regulations with regards to what type of collateral and what type of agreement that you have made underneath of one of these plans is going to be the same throughout. Now, there's not just self-directed individual plans, you also have business-based plans as well, which would be covered under the SEP IRA, the Simple IRA, and the individual 401k. Each one of those types of plans has an inherent base that makes most sense for it to be established for, and we can certainly review that. Since we're on a bit of a time crunch today, I won't enumerate specifically on the values of each, but please do reach out to us directly and we can certainly go over any of the finer points with regards to which type of plan makes sense for what type of business owner and what type of operations you're going to be doing. The last two types of accounts that we do offer are education and health savings accounts, and these accounts are established for the distinct purpose of having specific types of distributions made from them. Education savings account is specifically for qualified educational expenses, and health savings accounts are for qualified medical expenses as well. The contribution limits that you are going to be looking at are listed on the slide in front of you. We won't get into too much of a detail, but this will be on our YouTube channel, and if you would like to take a screenshot of that, here are all of the specific types of contributions that can be made. Now, do keep in mind that rollovers and transfers are not considered in factoring in if you have maxed out your annual contribution. So you can do a rollover of $10, $15, $200,000 and not affect your ability to make an earned income contribution of $5,500 or $6,500 depending on your age. Now that we've covered the basics, we can slow it down a touch and get into the types of investments that you can actually do under a self-directed IRA. Again, remember that every IRA can do any type of investing. The ultimate limitation on what you can do with a specific account is placed on you by the administrator and custodian of that account. We specialize in the hard-to-value or hands-on and non-traded assets, such as the one listed in front of you, mainly based in real estate, the other half of real estate being the notes and the financing side of things, which we'll cover today. But it's not simply just limited to that. You can also have the options of investing in single-member LLCs or different types of private placements that then maybe in turn invest in pooled real estate or larger notes. So don't just think that if you can't fund a note directly out of your account, there isn't the ability to form a joint venture or other type of private partnership that could essentially accomplish that note that you're looking to issue. Also, private company stock, foreign exchange, futures, and other investments such as oil and gas, tax certificates, debenture notes, commercial notes, and many other different types of self-directed assets lend themselves very well to being administered in these types of accounts. Now, the type of real estate and types of notes and mortgages is not restricted to just what people know and essentially generally associate with those. You don't have to just do a single family rental or do a rehab project. There are many different types of real estate out there, and any of them can be a viable option for you in your IRA. So with regards to that, don't just think that it has to be one specific type of investment. You can really try to make this work as best for you with what you are most familiar with. Now, with your paper assets, there are a myriad of different options for you. You could do something as traditional as a mortgage loan, where the IRA lends someone the money for the purchase of a piece of property. That property is purchased using the money that is borrowed. There is an interest rate, and then there is a recorded lien against that property that the IRA holds. failure to repay would result in the foreclosure and the receipt of that property back to the IRA, but there are also other options with regards to what people would know and are familiar with. You can do an unsecured loan. There is no legislation that states there has to be inherent recorded security to any type of loan issued out of an IRA. You could do corporate debentures, you can do option contracts, assignments, joint venturing, accounts receivable. The list really goes on with regards to the type of paper assets that you can invest in with your IRA as well. Now, this is more of a personal 2 slides moving forward for these two, because I'd like to make sure everyone that comes to our training understands that there are some inherent very big differences out there in the market with regards to how you move money between accounts. Now, most people will just inherently always use the term rollover, and they use it ubiquitously when talking about any type of movement of cash between qualified plans. However, people need to understand and be educated that there is inherent reporting and additional steps that need to be taken with each. Now, a custodial transfer is when you move money between 2 like accounts, so IRA to IRA, Roth to Roth. Essentially, just moving between 2 accounts is a custodial transfer. There is no reporting and no taxation with regards to that, and transfers between IRAs are unlimited. I typically encourage clients that have IRAs that are opening up the same type of IRA to do a custodial transfer. We request the funds be moved from your custodian, and then they are deposited to your new IRA. No IRS reporting, no taxation. It's clean and easy. The rollover is an actual type of distribution. Now, there are direct rollovers where you move the funds directly from a qualified plan, such as your old 401k, a 403b, governmental 457, thrift savings plan, or pooled pension, and they are non-taxable, but they are reportable. They're reportable on the side of the distributor, so the administrator of the 401k or employer plan, and they are also reportable on receipt by the receiving custodian. So you have 2 different pieces of tax reporting that are going to be issued, and you need to make sure that they are both done correctly by the issuing and the receiving entities. So if you don't have to do a rollover, I do encourage people to do the transfer. However, the direct rollover certainly does have its place, but don't only think that's your only option, and do understand that there is inherent reporting, and you do need to make sure that the reporting is done correctly for your personal tax returns, as if it's not, there could be potential issues that arise when trying to file your personal taxes. So that is, again, my personal input into this presentation. Knowing the difference between a transfer and a rollover can help you set up a good base for success when doing self-directed retirement investing. Now, understand that there are not a lot of restrictions when it comes to the type of investment you're doing. Again, you are fully able to choose your interest rate, essentially the rate of return for your loan. You are able to choose the length and term of the loan, so you can issue a 5-year loan. You could issue a 1-year, 6-month, 30-year. You have the ability to choose the amount of time that your money is outstanding, and a bunch of different other aspects with regard to how that money is repaid, but there are inherently a few items that you cannot invest in. So anything that is going to be a life insurance contract, typically a life insurance contract is paid out tax exempt, so it would create a tax shelter loop within an IRA to have one in a qualified plan, so they are not allowable. And anything that derives its value from collectability, such as antiques, rare bottles of alcohol, artwork, stamps, and coins, although some coins are allowed to be held in an IRA if they are traded on minimum fineness requirements of bullion content, such as American Gold Eagles, silver, platinum, and palladium are all acceptable types of coin investments. However, the main reason behind the collectible restriction is that everything in an IRA has to have some type of readily determined value. Now, some of those values may be harder to determine than others, but inherently anything that is listed up there that's collectible is extremely subjective. So it's easy enough to get an appraisal on a piece of property, or to determine the outstanding principal and interest payments of a loan. But antiques and things like artwork are inherently only going to be valuable in the amount that someone is willing to pay for it by how much they inherently like it. So those are not allowable. Now, with the exception of collectibles and artwork, there are a few people that you cannot invest with. So for the purpose of this presentation, you could not lend money directly to your spouse, you could not lend money directly to yourself, mother, father, or son and daughter. The actual type of people these are considered is disqualified persons being direct lineal descendants or ascendants of yourself personally. So if you look at your family tree, just imagine that the person directly to your left, your spouse, is disqualified, and anyone directly above and below you, being children and parents, is also disqualified. Now you can certainly partner with these people, but you just can't transact on the opposite sides of the closing table with them. One interesting caveat to this is that brothers and sisters are not considered disqualified individuals from your IRA. So you could potentially lend money to your brother or sister. However, you would need to be responsible for making sure that any such loan is done explicitly along what is currently acceptable in your market. So if a mortgage loan on a house that is private is going for 5%, making sure that it's lent between 4 to 6 is a good rule of thumb for you to follow. Again, if you're lending unsecured hard money and it's going for 12 in your market, making sure that it's roughly within a point above or below that is a good rule of thumb to follow. Ultimately, it comes down to you as the IRA holder to make sure that everything is being done compliant and in best interest. But those are some of the general guidelines that I typically tell people to look at with regards to dealing with siblings. An easy way to avoid any ambiguity in those rules is to deal with a clear third party with regard to the investment that you're doing. Understandably, it's not always applicable to do that, but typically that will alleviate most of the concerns with regards to violating IRS rules. Okay. Do apologize that we had the technical issues and had to speed through the first part of it, but we will slow it down here because we are actually getting into what you signed up for today, which is the actual nuts and bolts of the different types of loans that we've seen, how people are structuring these deals, and what it looks like to have one underneath of an IRA with regards to the procedural aspects and with regard to what is done with the loan after it is funded. Now, I've mentioned that there isn't any one prescribed solution for the type of lending that you're doing. I would encourage people, if you're familiar with lending and the aspect of doing it personally as an investment, try to transcribe that into your IRA, because one of the nice benefits of a self-directed IRA is that you get to not only invest in what you know, but with who you know. So if you've been doing loans with people and you are always doing them as secured first mortgages, you don't have to change that structure of what you're inherently familiar with in order to do it in an IRA. You just have to understand that there are some administrative changes that are made to how it's funded and how the note and mortgage are titled with regard to the lender. But other than that, if you can do this personally, you can typically transcribe that and do it in an IRA. So some of the different types of loans that we see are traditional mortgage lending, anything from a 15 to a 30-year term. We also see 5-1 adjustable rates and balloon mortgages. Do remember that the majority of these are being lent out as investor loans, so some of the regulations regarding them are a little bit different than if you are dealing with owner-occupied residences. Ultimately, if you have questions on the applicability of any lending laws, you would need to get qualified advice from someone that is a legal authority in that arena, with regards to things like Dodd-Frank and other lending regulations. You would need to check with that, as it does apply in some cases. Again, I would say that looking at lending to investors will help alleviate some of those things, and not dealing with owner-occupied properties will typically maybe streamline some of the processes for you. So you can certainly do any type of lending that you wish in it, but understand that there might be some additional loops additional requirements that you have to abide by in order to make it a viable investment for your IRA. You don't have to do long-term lending. We can do short-term loans. You can do transactional things where you have notes getting paid off and sent back out on a faster basis. There's nothing wrong with that. We have the ability to issue unsecured promissory notes if you would like. If you find a deal that doesn't lend itself to having any applicable type of security, maybe there is a situation where someone doesn't have any unencumbered assets to give as security, but they will give you a much higher interest rate, you can certainly take advantage of that. But do understand if there is no collateral to the loan, it inherently is going to be a slightly riskier venture for you. So making sure you do your due diligence, your research, and seeing that the person is a trustworthy individual to repay the loan is certainly advisable in that situation. Now, with the change in the marketplace, one of the more interesting things that I've seen lately is the advent of more equity participation notes that are being lent out from our clients. For those of you that aren't familiar with what equity participation is, we will have a case study that goes over that here in a few minutes, but essentially, people that need to utilize more of the money that they borrowed for either a rehab project or to get something else done with the property, they may not have the ability to pay, or it may make more sense for them to be able to get something back on the market quicker if they're not having to pay a monthly interest payment or principal and interest payment. So instead of having an interest rate or payments on a monthly basis, there will be written into the loan that at the time of sale of the property, a portion of the profits will be distributed back to the note holder as the consideration for the loan. So if someone lent out $100,000 and there was a $30,000 profit made on the property and they got 1/3 of the profits, they would receive back $110,000 at the end of the term of that loan once the property is sold. Instead of getting a fixed interest rate, they do get to participate in a little bit of the market fluctuations, which is a nice aspect of that type of loan. Because keep in mind, with a set interest rate, you may not inherently get to participate in the equity growth of a piece of real estate, but you don't have as much of some of the liabilities that are associated with real estate as well. Some of the market volatility might be insulated from you by having a fixed rate loan, but you also don't get to necessarily see the upside in the sale of the property as you are locked into a certain rate of return. And just another aspect that's not seen as often, but certainly is very popular for some of our clients, is that real estate is not the only type of collateral that is associated with lending. Most people are familiar, if you had to borrow money to buy a car, that there might be opportunities out there for you to lend on vehicles or other type of equipment, especially with large pieces of capital equipment such as farm equipment, machine equipment, different types of shops such as auto mechanic shops or maybe fabrication shops need to buy different pieces of very expensive equipment. You can certainly have a recorded lien placed against that and lend out of an IRA. If you're familiar with that type of industry, there's also the ability to lend for people to purchase livestock, such as cattle or other types of animals, and you can certainly use that as an opportunity, if you are familiar in that arena, to make some money with your IRA and not pay any taxes. So we've discussed that there are different types of loans that you can do. There's different types of security to the loans that you have. But what do you do when it comes to actually making the loan? Well, you as the client are the one that is going to be taking point and going out and finding the person to borrow that needs to borrow the money. You're going to determine how much money they need. So the first step is to determine who needs the money and how much they need. Then you would need to negotiate the interest rate, so how much money that they are going to be paying as the fee for borrowing the money, the length of time that they have to repay that, whether or not that this is going to be an amortizing loan. That means that whether or not you are going to make every month a principal and an interest payment. You can have interest-only notes. You could have a principal-only note. You could have grace periods for payments. There is a ton of flexibility that you as the client have to make it a good investment for you and a good product for the person that is utilizing it, meaning the person that is actually borrowing the money, making it the best possible fit for them to repay you and for you to make money on the investment. So again, try to think outside the box on this. What is going to make the most sense for that person borrowing the money, and is it going to also inherently make it a better investment for my IRA to do something that is not as traditional as other aspects of lending? Not to say that you have to always think outside the box and do something crazy, but just understand that the ability for flexibility in determining the terms of your loan is available to you. If you want to have any equity participation, again, going into the actual construct of the note is completely up to you as the client and the borrower as to determining whether or not that needs to be included in the actual loan documentation, and also determining where the loan is paid and how and what date of the month that it is paid to your IRA as well. All these things are going to be determined by you and the borrower. Advanta doesn't have any say in this, so you really do have tight control to invest this in exactly how you see fit. Now, there are a lot of benefits to private lending. I went over some of the downsides in that you don't necessarily always get to participate when the market increases dramatically in value, because you do have that fixed rate of return. But again, that is a very good thing in some markets. If you have a lot of market volatility, you get to determine a fixed rate of return, and especially if you have collateral that has good loan to value, you can certainly make it a very secure investment as well. You get to act and determine the terms of this. So that's one of the very big determining factors of making this attractive to most people, is that you as the client get to take what you know and what you understand about this marketplace and determine what makes the most sense for you and actually act as the bank. You get to set the rate at which your IRA will grow. So again, you can either be more conservative with things like lower interest rate first mortgages, or more aggressive with higher interest rate unsecured loans, but you get to choose inherently how much risk you are presenting yourself and how much of a rate of return that you're also potentially putting into your IRA as well. There is inherently less liability from things like trip and fall accidents, owner's liability associated with properties that your IRA will not be subject to by being the lender. Some people say it's very hard to trip and fall over a piece of paper, and it does hold true, is that you are not going to be the one being sued if you lend someone money on a piece of property as opposed to the owner. Again, the actual limits of liability is something that you need to check with a tax or legal expert on, but typically, as we talk about, this is going to be something that's going to help you mitigate some of that liability that your IRA might be exposed to with these types of investments. You can essentially have very low maintenance costs for that asset. Now, after you have issued the funds for a particular loan, for lack of a better term, you kind of sit back and collect money. Obviously, some types of investments might have a little bit more hands-on aspects, or if there's ever an issue, such as non-payment or default, there can be some maintenance cost and legal costs associated with that. But in the normal course of a promissory note, there really isn't too much that's done by the lender on the day-to-day, as essentially it is a promise to repay on behalf of the borrower of those money. And you don't always have to have the full amount of money in your IRA in order to make an investment. You can utilize partnership agreements in order to bring the amount of capital that you are presenting up to a level where it makes sense for the particular investment. So if you only have $100,000 in your IRA and you'd like to make a loan that's $200,000, you can find a partner to do a tenant in common loan to the individual borrowing the money and make that happen, whereas you wouldn't have been able to do it on your own. And you can partner your IRA with other individuals. You can partner with other IRAs, LLCs, trusts. You could even potentially partner with disqualified individuals if you are doing it in the correct type of partnership structure. Again, if you have questions about the partnership structures and how to do that correctly with regards to disqualified individuals, give us a call. We certainly are happy to go over that in more detail, but that is a very specific type of investing, and we would like to kind of not get into all the details of that in this presentation. So our first case study. We're going to be looking at a first mortgage on a piece of property, meaning that in this case, Paul has $120,000 from a former 401k employer. Now, keep in mind that with this 401k, he's going to be doing a direct rollover to his new traditional IRA. He's going to do all the research and determine what terms that he wants to lend out the money from the IRA. So he's determined that he wants to maybe do a little bit of a lower risk investment, or maybe this is the best investment for the particular marketplace that he's found. So he's going to be doing a first mortgage on a piece of real estate. So he works with a mortgage broker to get his $120,000 placed with a particular borrower. He has negotiated the terms that he's going to be lending out the money at. So looking at the terms of this loan, and this is a good representation of actual investments that have been done by our clients. Now, obviously, the rates of return and the viability of this is not implied to be guaranteed or anything of the sort, but it's a good representation of what is potentially possible with this type of account. So he's lent out $120,000 at 8% interest on a 5-year balloon note. The monthly payment is $800, and he has a first mortgage on the property. Now, if you're not very familiar with loans or you're just trying to get into this, think of this as something very similar to a certificate of deposit or a bank CD. You give them money for a certain period of time for a guaranteed interest rate, and at the end of that term, the underlying principal, the amount that you put into the CD, is paid back along with the interest. So a very similar type of construct to a promissory note, only in this case you have negotiated a much higher interest rate than what you would typically ever see from a traditional bank. Now, how does this work administratively? This is not as streamlined as just going to someone and saying, "Hi, would you like to borrow money?" Them saying yes, and you handing them a stack of cash. There is some inherent steps to make sure that this is done correctly, funded correctly, record kept, and essentially maintained so that you can enjoy all the tax-deferred benefits that go along with having an IRA. So from start to finish, Paul would need to open the IRA. He found the loan and analyzed the terms. He made an offer for the person to have the loan. He submitted the purchase forms to Advanta, and he read and approved all of the loan documentation that was provided by the mortgage broker. Our responsibility in this case is to review the documentation for proper IRA vesting, meaning to make sure that the lender is properly titled as the IRA on the note, mortgage, and any settlement statements or policies of lender's title insurance. We wire the money to the title company for the closing, and we follow up and ensure that the original mortgage is recorded and received by Advanta post-closing. And then after that, we collect or have the payment sent to Advanta for the actual note. All right. So after the close of escrow, the borrower sends all of the interest-only payments to Advanta. They are deposited to Paul's IRA, and he uses the online access that he has at Advanta to track everything to make sure that the borrower is paying on time and to see his increase in cash balance with regard to the monthly payments that he is receiving. So 3 years later, the borrower decides to sell the house. When the property sells, Paul's IRA receives $120,000 from the sale of the property, and the interest will not be subject to any capital gains, and none of the interest payments were ever subject to ordinary income. So all of the interest payments that were accrued over those 3 years are completely non-taxable. And keep in mind, you don't have to track the basis of what would be considered capital gains or ordinary income, because at the end of this road, when you distribute money out of a traditional IRA, you're only subject to ordinary income at your current tax rate. So you really do streamline your taxable liabilities from the traditional investor point of view when doing it through an IRA. So whereas you do have some different administrative things you have to do, the actual ability to make your taxation a lot easier is achieved by doing it through an IRA. Second case study, we're going to be looking at equity participation. So in this case, Andrea belongs to a local real estate investment club. Through the club and the networking, she finds some people that are interested in doing fixing foreclosure properties, and they need money to finish their projects. So she has $100,000, but she's now invested in traditional products like stocks, bonds, and mutual funds. But she obviously, through networking and realizing that people are borrowing and paying back money at a much higher rate in these groups, has decided that she could potentially get a better rate of return by investing with these real estate investors. So again, she performs the due diligence herself, and she finds Steve that is going to be buying a property to flip. The cost of doing any due diligence, if you're going to be doing any sort of credit check or if you're going to be doing any sort of background check or things that are directly associated with the investment, they need to be paid by the IRA. And at the end of her due diligence period, she decides to lend Steve the $100,000 to buy and fix the property. So with regards to this, now again, remember that you can't, sometimes you do and don't have a monthly interest payment. I've seen it done either way, where there is only the equity participation as the consideration for the borrowing of the money. You could certainly have an interest rate in there, be it anywhere from low to high. Again, this is all going to be negotiated between you and the borrower as to what makes the most sense. So in this case, there's the $100,000 of underlying principal that is being lent out at 5% annual, with an equity participation of 1/3 of the profits at the sale of the property. There is a 2-year balloon payment on the note, and the monthly payments work out to be $420 a month interest only, and there is a recorded first mortgage on the property, meaning that if the borrower fails to perform on the note, then the property will be foreclosed on, and she will receive the property back into her IRA. So with regards to the documentation on this, Andrea's attorney prepares the note and mortgage. So again, making sure you have someone that is legally capable of providing this type of investment documentation is key. One, to make sure you have a valid and enforceable lien if it applies, and two, to make sure that there is solid language for the repayment of the principal that you have lent out. She would need to read and approve all documents that she sends to Advanta, meaning that we are never going to fund anything for a client's account unless they have explicitly read it and understood it. This is accomplished by them reading and putting their initials or signature on each page as read and approved. At the payoff of the loan, this is where it gets kind of interesting. Steve is ready to sell the property for $130,000. So he purchased it for $100,000 and he's selling it for $130,000. He requests the loan payoff from Andrea, and the servicer and Andrea provide a payoff letter. The payoff letter is sent to the title company, and then we're ready to close. Now, here's how the investment shakes down for both individuals. So Andrea had the $100,000 that was lent out of her IRA. At the end of the investment, when the property is sold, she has received $2,500 of interest payments. She has her percentage of the profits, which is $10,000, so her total earnings is $12,500. So the ROI, or return on investment, is $12,500 on the initial $100,000 that was lent out, which easily enough works out to 12.5% return on investment through the course of this loan. Now, Steve's earnings is a little bit interesting to look at from his perspective. So he borrowed the $100,000, so he has to pay that back, and he sold the house for $130,000. With the repayment of the loan, points, and interest, he pays back $12,500 to Andrea's IRA, leaving him with $17,500 of profit made on the sale of the property. So you can see how this is a good deal for both people, and it really makes sense that they would both want to enter into this type of agreement when the numbers are broken down like that. Now, we've covered 2 case studies that go into the specifics of using real estate as collateral, but you don't have to. Again, remember that we covered the ability to use things like farm equipment, potentially have livestock or other different types of non-traditional security to loan. So understand that there is the ability to have different types of things securing it. However, you could run into some issues depending on what type of collateral there is if there ever needs to be a foreclosure. So if there is the beneficial interest in an S-Corp that is issued as the security to a loan, an IRA cannot be an S-Corp shareholder. Or if there is something that is going to subject the actual IRA to business income taxes that would be associated with running a business out of it, just be aware that if the security is going to be something that is a business or an active business, you might want to go to a tax professional to look at the potential issues that might arise if you ever had to foreclose on that underlying security. So just understand, typically in the course of traditional real estate, you're not going to run into any of these type of problems, but when you get to be some of the more exotic, if you will, types of security on a loan, that there might be some additional considerations that need to be advised upon by a qualified tax or legal expert. Unsecured lending. By far, definitely the highest risk value of these types of cases that we're going to be looking at today, just because that in the event of default, there is no recourse to the lender except to sue the borrower personally. So there isn't any type of capital asset that can be foreclosed on in the court of law. You actually have to go sue the person. So understanding this, typically with these types of loans, there is a higher interest rate, such as in the case of Tom's SEP IRA. He has $50,000 that he's looking to lend out, and he has a friend that wants to expand his business and needs short-term capital. And typically, what we see is that the unsecured notes that are done by our clients are inherently a lot shorter of a term, meaning that you're not going to be lending out unsecured money for a long period of time. These notes are typically anywhere from 6 months to 5 years for the most part of what we see, as opposed to the 5 to 30 years that are seen on a lot of mortgages. So his friend that needs the short-term capital comes to Tom, and he has the $50,000 in his SEP IRA that he's willing to lend. So he has a qualified person draft the promissory note that is going to be signed by the borrower, and the terms of the note are $50,000 lent out at 10% with a 1-year balloon. So the lump sum payment after 1 year of outstanding of the note being outstanding is $55,000. Now, again, with unsecured lending, there are some very specific considerations that you need to look at with regards to doing this type of investment. Because there is no title company or escrow agent, make sure that you understand that the original note has to be received by Advanta before we can actually issue funding. We need to make sure that we have the original instrument that is the investment for your IRA in our physical possession before we can fund on these. And again, that might factor in a little bit into the timing of when the loan can actually be funded. Since the unsecured lending is a little bit riskier than things that fall on the spectrum of more conventional lending, these interest rates are typically going to be a little bit higher, and most people kind of look to credit card interest rates as a good determining point for where to base their interest rates off of. And you do inherently need to do a lot more research in this, because if there is a default, you're going to have to come after that individual personally to recover. So making sure you know this person or have done very good due diligence on their ability to repay your IRA is certainly advisable in this case. Now, let's say you own property in your IRA, and instead of owning property, now you would like to have loans. So instead of having a capital asset, now you would like to have a revenue stream in your IRA. Well, you can certainly do that. If you owned a piece of property, instead of the buyer going to a different bank or another individual, your IRA could hold that note, and then instead of just getting a lump sum payout, you receive a note with a secured interest in the property and monthly payments. Now, in this case, Jim has a traditional IRA with $70,000, and he's been buying foreclosures and fixing them up. He buys a foreclosure for $40,000 in his IRA and uses $10,000 to fix up the property. So now he's into the property for $50,000 of total purchase, 10 plus the 40 he purchased it for. He sells the property for $80,000 to an individual and finances $70,000 of the purchase. So with a $10,000 down payment, they finance $70,000 of the loan, of the purchase price of the property. The loan amounts $70,000 with an interest rate of 8% annual and a 15-year amortization with a monthly payment of $670. Now, 15-year amortization means that the loan is factored in to have payments of principal and interest that will result in a net zero balance at the end of 15 years. And the first mortgage on the property refers to that you have the most senior lien on the property, meaning that if you have to foreclose, it is the first in line to receive the interest in the property if it has to go to that point. So throughout this process, Jim buys the property of foreclosure. After fixing it up and doing all of the work on the property, or the work being done by a third party, he ends up getting a down payment of $10,000 and financing $70,000 of the purchase and holding the note in his IRA. So in this case, we would process the initial purchase of the property and send all of the checks for the repairs. We would process all of the sale paperwork and the carryback loan on the property as well. So we are going to be purchasing, selling, and holding the loan on the property as well. We're also going to be making sure all of the vesting on the note, mortgage, deeds, all of the sale agreements, sale contracts, settlement statements, everything is properly titled in the IRA and properly signed by an authorized signatory of Advanta. And then furthermore down the road, we will be collecting the actual income, be it the note payments, into the IRA as well, which of course are not going to be taxable. So, how do you get started with this? It's easy enough, as we previously discussed with the actual traditional rollover and the actual IRA transfer. It's as easy as just opening the account and moving money from a qualified plan into here. As you can see enumerated in front of you, it's really not the hardest part of this. William, yes, can you print copies of the slides? You will receive an email that has a link to our YouTube channel so you can see the actual slides and presentation. But if you would like, please, everyone, if you have any questions, feel free to give us a call or shoot us an email. My email, my last name at advantaira.com. If you'd like a copy of anything, please do let me know. Again, I do thank you for those of you that stuck around through our technical difficulties. I understand we had to, kind of push through a little bit quicker than we wanted to on some of the basis that I like to give in these presentations that are introductory into a specific type of investing. So if you do have any other specific questions, I'll stick around until everyone's signed off. Please do type them into the chat box. This will be hosted on our YouTube channel as well, so please feel free to peruse it at your leisure on there. But please let me know if you have any questions and if we can help you. Other than that, thank you very much for attending today and have a wonderful rest of your week.